Hello, everybody, and welcome to Hash Rate. My name is Mark Jeffrey, and with me is Fred Krueger. Hello, Fred.
Hi. How's it going?
How you doing? Good to see you. So we're going to do a little episode here that I call What Just Happened, right?
Oh.
So the first 6 months of 2022, absolute disaster in crypto, right? So you and I, we're going to do a little bit of, we're going to do an autopsy on what just happened, how it happened, and where we go from here. So I thought we'd start with sort of the Nexus event, the patient zero that wrecked the entire timeline, plunging us into a Thanos-dominated world. And that, of course, is the collapse of Terra LUNA. So, so I'm going to start off by sort of describing exactly, first of all, how it works and then how it collapsed. And you chime in as you sort of have thoughts. So the goal behind creating Terra LUNA was to create a purely algorithmic stablecoin. So something totally untethered from the banking system, the anti-tether, if you will, right? So the mechanism by which they did this was they created a new coin called Luna, and there was a fixed max supply of Luna, and so sort of like Bitcoin, right? There's an uppermost limit to it. And to mint the stable coin Terra, one burned Luna. So this reduced the amount of Luna that was available in the market and created Terra stablecoins that were worth exactly $1. So the more Terra stablecoins, as that became popular, and there was more Terra in the world, there was less and less and less Luna, which tended to make the value of Luna go up in value, right? So far, so good?
I'm not 100% sure I agree with you on the max supply of Luna. Because in the very end, I think the supply went up very, very heavily.
It did.
And I'm not sure, did they do that by governance or how did they do that?
Well, because Luna became worth less and less. So as you burned $1, so I guess there isn't an actual upper supply. I think you're right, actually. Yeah. It's not like Bitcoin. But basically the idea is that you burn $1 worth of Luna and you get $1 worth of Terra or one Terra coin.
Right, but on the opposite side, if the price is going down and they're minting more Luna, the amount of Luna in circulation could, in theory, go to infinity, I think.
Right. It went into the trillions. I was watching it as it went up. So it went up to something like 7 trillion, like in the matter of minutes, from like 1 trillion, right? So, kind of at the end of the death spiral. So in the beginning of time, Luna time, that is, the Luna Foundation minted a bunch of Luna, and then they burned that to mint some Terra. So they had this big pile of, kind of free dollars, right, that they created out of thin air on their end. And then they kind of piddled along for a little while without really getting much adoption. Then they stumbled upon Anchor Protocol. And this was something where they basically told people, this is where you store your Terra, and you get 20% APY, right? So, and the way that they covered that, I believe, was by using the Luna Foundation's free dollars that they, conjured out of thin air by burning Luna tokens kind of early in their timeline. And so they had this big pile of these Terra dollars, and that was how they bolstered the 20% yield. With me so far on that?
Yeah, I think their original idea was that there would be sort of borrowing activity from Terra people who wanted to borrow from Terra would contribute some of the yield. So they always had sort of a deficit story, that some of the yield, but they basically were at least alleging that maybe 10% of the yield was sort of doable organically, and that the other 10% were sort of a gift from the Terra Foundation for ecosystem development. So at least that's the way it was pitched.
Got it. Okay, so that sounds right, actually. So yeah. If you can make 20% APY on your dollars, right, your safe, your dry powder, why wouldn't you keep your money in Anchor, right? And that's kind of what everyone thought. And the common sense in crypto at the time was that this was safe. And at least that's what a lot of, smart people and hedge funds even thought, right? So, we've since learned it wasn't safe, but that was sort of the common meme at the time. So, this sort of blew up into, I think it was a $60 billion ecosystem at its peak, right? And we talked about it while this was going on. I remember you and I had some conversations about it. I never liked it because I didn't like the single point of failure in Luna, right? So the thesis in my mind was if Luna drops in value for whatever reason, that is the only thing backing these, these stable coins, these dollars. Right. So if that falls apart for I don't know what reason, but if it does, then all those dollars are worthless. So I didn't like it from that perspective. I compared it to, I like MIM, right? So MIM was backed by 30 yield-bearing assets. So, if one of them went under, well, it wouldn't be good, but you'd still have 29 others left, right? So I won't get into that right now, but that just, that was sort of how I compared it.
Mm-hmm.
So Do Kwon knew this objection that I had because others had it as well. So he started trying to shore up the the collateralization of Luna. It was not collateralized at all before he started trying to shore it up. And he basically did two things. He said, I'm going to buy some Bitcoin. I'm going to buy a total of $10 billion worth of Bitcoin. And I think he immediately bought, I think he had about $2 billion, which he bought right away when he made that announcement. And then the second announcement he made was that he was going to be instituting a new Curve pool called the 4 pool. Now, Curve is sort of this odd beast, right? For those of you who don't know, it is a AMM or a decentralized exchange. And things like Uniswap, which are also decentralized exchange, work by having pools of liquidity tokens. So if you have ETH trading against Tether, you always have 50% Ethereum and 50% Tether denominated in dollars in the pool. And if a trade occurs which causes the pool to fall out of whack, the pool will seek to reestablish the 50-50 balance by changing the price of one token or the other, right? So it's always it's an active participant in the market. Curve has 50-50 pools also. However, it strives not to have the price change. So basically that's why they call it Curve, because you can have a pool that's wildly out of whack, say 95%, 5% of one token versus the other, and the prices of both tokens won't change. This is ideal for trading stable coins, right? If you're trading, especially in large amounts, if you're trading $10 million worth of Tether for $10 million worth of USDC, you don't want to lose like a whole bunch of it because of a price fluctuation in a DEX. So Curve is very good at preserving, especially for large stablecoin transactions. It's awesome at that. So in order to, and basically once the Curve pools become big enough, they become the arbiter of whether your stablecoin is accurately retaining its $1 peg or not, right? Curve becomes the source of truth. And this will become important later to our, how Luna was depegged story, right? So we're in agreement so far?
Yeah.
Okay. So at this point, Do Kwon is kind of strayed from the pure faith, if you will, right? By attempting to collateralize his non-collateralized algorithmic stablecoin. He's doing some things that are sort of unnatural to its design for the first time. Some argue that if he had not done, he not strayed off this path, he might have lived. He might have survived this. I don't know if that's true or not, but that is one school of thought. So now let's go into what happened. So basically what happens is, now along comes the spider, right? Some say it's Citadel, some say it's, just the market, but I'm just going to call it the spider so that we don't say it's Citadel.
Celsius.
You want to say it's, you think it's Celsius? Okay. Well, some people think this was a malicious actor that was actually attacking Terra and trying to kill it. Who knows? So the spider says, hey, Do Kwon, we'll sell you $3 billion worth of Bitcoin for your Terra, right? Now, if you're Do Kwon, you're like, well, geez, I just minted this Terra using Luna by burning Luna, which is a coin I just minted out of thin air. So that, $3 billion worth of Bitcoin for UST, that's a great deal. I'm going to do that. So Do accepts. And with this one move, Do Kwon has now armed his enemy with the tools to destroy him. So what happens next? So in preparation for creating this 4 pool, which is basically Terra, Frax, Tether, and USDC, this new pool they're putting up on Curve, which is going to be enormous and bolster the stability of all 4 of these stable coins. The first thing Do does is he drains liquidity from the 3 pool, which is the dominant stablecoin pool on Curve. So at this moment, it's a lot easier to sort of tip that pool over, right? So his pants are down, basically, is a way of thinking of it, right? So as he's in the middle of moving tokens, that's when the spider attacks. So the first thing the spider does is it basically uses $3 billion worth of Terra and sells it all to the pool, causing it to fall further out of whack to 95% Terra, 5% other stable, right? And when a curve pool gets out of whack like this is when all hell breaks loose. And by that I mean the peg starts going, right? So UST starts to depeg. So now all of a sudden people are saying, oh my God, it's worth 97 cents. On the same page so far?
Yeah.
Yep. Okay. So as UST starts to depeg, this causes redemptions of UST for Luna. So people are like, oh my God, I better get my Luna back into $1, because you can always trade it for $1 worth of Luna. So if I have 97 cents worth of Terra, and I can trade it for $1 worth of Luna, well, shit, at least I'll do that, right? So that starts happening, which starts inflating the supply of Luna, which causes the price of Luna to start dropping, right? And this causes Luna to start selling Bitcoin to buy more UST to defend the peg, which plummets the price of Bitcoin. Now, our Spider had previously also placed a short on Bitcoin. So at this point, because they know that this is going to happen, right? They know they're forcing Do Kwon to start selling his Bitcoin to defend the peg. So they start making money on that. So as Luna and UST drops, this then also causes a bunch of cascading liquidations in DeFi as other protocols liquidate assets that fall below their collateralization ratio. So this begins the shitstorm, and which basically destroys $60 billion worth of value if you simply consider everything that was in UST and Anchor.
And Luna.
And Luna. Right. And also people start pulling their money out of Anchor. So at the moment they pull the money out of Anchor, you basically get a situation where the redemptions, you owe whatever part of the 20% that person had accrued over the year, so they have to, overpay out beyond even what they have.
Right.
Okay.
I like that narrative, but I'm not 100% sold on it, and I'll tell you why.
Okay.
Because I think part of the problem, I think that worked very well for the small retail investor. I'm not even sure how many small retail investors were directly involved in the Anchor protocol. But I think one of the things that clearly happened is there were other people who were saying 20% is great. Now, I've got a bunch of retail investors, and I'm probably thinking Celsius here, right, with 1 million people. And they're like, I'm paying these people 6% on their stable coins. Now, if I can earn 20%, that's an enormous spread. So now you have one enormous investor, Celsius, which had some enormous position in Anchor. And we know that they had an enormous position in Anchor at one point. Now, they got out, right? They got out before it hurt. That's not what hurt Celsius. But the fact that Anchor actually didn't have 1 million small investors, it had a few really big investors in the 20%, right?
Right.
Some of who are leveraging that 20% against borrowing costs of say 8% elsewhere, and so Voyager, Celsius, I'm sure there are many, many other ones as well that we don't really even know about. But there are a few of these aggregators who were able to come in. Now the problem is that's great on the way up because all you need is to get a Celsius, and all of a sudden you get 500 million TVL.
Right.
On the downside, all it takes is one of these people to get cold feet, and then all of a sudden you can get an amazing precipitation on the downside, right?
So reverse TVL, everyone's pulling out.
It's reverse TVL, right? So I think, I'm not sure if there was a malicious actor or not, but I know that Celsius was one of the first to sort of get cold feet, and maybe they were just alerted by the fact that Do Kwon was buying this Bitcoin, right? Which is, it sort of says two things. Number one, it says, my original idea, I don't really completely believe in it myself, right?
It sort of does say that. I agree.
So it's sort of like if the person, imagine if Bitcoin was also backed by dollar deposits.
Right.
Satoshi came out in 2015 and says, you know what, the original idea is great, but let's also have these dollar deposits here. And people would be like, wait a second, I thought the whole idea was 21 million coins and there's no, and it just works. So the fact that you're changing the formula, and you're not changing it very much just at the beginning. You're changing it once this thing has already gotten to $40-50 billion.
Right.
That's very scary for people, right? So it's sort of like, what does Do Kwon know that I don't know? Right?
Yeah. Well, I think, that goes back to the thesis that if he had not strayed from the pure faith of a purely algorithmic stablecoin,
that's the first thing. And the second thing about it is, by actually buying the Bitcoin, he's pushing a lot more Terra onto the market, right?
Yes.
And so that Terra normally would buy up the price of Luna, right? And it would kind of continue his journey. But here, no, that Terra is being used just to buy Bitcoin.
Yes.
So again, it deviates from the whole model. So was the whole model accurate? I don't think the whole model was accurate, but I think this deviation was very, very dangerous and suspicious.
Totally agree.
And so, so that's what I think. I think that definitely caused. And the other thing is, I think this model, if you work through the math of this model, it works for normal perturbations, right? So if 1% wants to buy or sell, no problem. The math works, the model works, the arbitrage stuff works, and et cetera. But what happened here was an abnormal move, right? It's Celsius all of a sudden pulling out $500 million. Perhaps it's some other entity maliciously coming in and pulling out a whole bunch of money, right? But whatever it is, those, extraordinary 5 sigma events actually can happen in a pretty ordinary way, right?
And, right. The speed of it was just stunning. It was like 48 hours from, to go to zero.
Right. And so, but I think that's part of the endemic properties of this stuff is that they can hit these things pretty quick. And it's not like a 100-year flood, which only happens occasionally. No. This is part of the design of the system, Right. And it sort of happened with another coin, the Titan coin, earlier. And everybody was like, well, that was a bug. That was a problem with the protocol. Well, so was this. This is a fundamental problem with the way the protocol was designed.
So which happened first in your opinion? Did Celsius cause the destruction of Do Kwon, or was it the other way around?
I think Do Kwon. What's first, the chicken or the egg, right? So. Yeah. Do Kwon was the chicken, Celsius was the egg, right?
Yeah.
But the egg deciding that it wanted to part ways with the chicken caused the demise of the chicken, So the two are connected. The two are connected at the hip.
They are.
And I think everybody was very transparently saw this, because you can't move this kind of money around without sort of leaving lots of tracks on the blockchain and in the community. And so I think Celsius, was one of the first people that was involved, and they came right out and they sort of said, hey, look, we're protecting our token holders. See us, we're great,
Right.
Now, again, that I find that they sort of made that statement about trying to distance themselves from Do Kwon. But again, now everybody sort of took a step back and they go, wait a second. You're telling me that you were taking our money and you were simply investing it at 3 times the yield over an anchor. So that's your DeFi strategy. Holy cow, that's it? You weren't doing anything more complicated than that? And now you're just got cold feet, so you pulled out? Well, what if you hadn't pulled out? Then I might have lost everything. Right? So again... That defense, I think, caused Celsius a lot of credibility.
So what went wrong here? It doesn't seem like DeFi was the problem. That appears to have operated and remained solvent. It looks like CeFi and the humans were the problem. Do you agree with that? Is that your perception as well?
Well, no, I don't quite agree with that. So what I think is that DeFi enabled CeFi to structure these incredibly risky positions, right? Now, an example of that is, and this is something I wondered about initially, which is, okay, how can Celsius offer 5% return on Bitcoin? Okay, there doesn't seem to be anybody who wants to borrow Bitcoin and will pay 5% to borrow Bitcoin and repay back the same amount of Bitcoin plus 5%. I just don't know of that person. Right? And so,
right.
There's no direct way to do that trade. However, what Celsius did was they took the Bitcoin, they put it in a vault, right? Then on Compound Arave, and then they borrowed stable coins against that Bitcoin, right? So, yeah, that part of the equation held up very well. Right? It is true that they did that, but now look what they did. They put the customer collateral into these vaults. They took the vaults out, and now they had this thing where they needed to make 20% on stablecoins. And they did some very crazy things to make 20% yield. Some of that was invested in Anchor. And look, I don't have all the details, so it's all speculation, but we do know that they bought a mining operation, right?
Right.
That doesn't seem to have anything to do with making yield, in my opinion. That seems to be sort of early stage venture capital kind of thing. They put money in staked ETH, some in the staked ETH on Lido, but some directly into staked ETH that they might not even be able to get out.
Is this kind of like the Glass-Steagall kind of bullshit that the banks pulled in 2008? Isn't this analogous in your mind?
I think it's the problem is we have structures for people who want to take risks and invest in things called hedge funds, right? And they're very simple rules for that, right? They're meant for accredited investors only. They're not sort of mom and pops. And you have to have very clear disclosures about what you're going to do for these hedge funds. And they tend to get audited, and you have very specific return, like how you're going to get paid as a result of the hedge fund. So typically they work in something like 2 and 20, like 2% management fee, 20% of the profits above some threshold, right? Now that's a hedge fund. Now, if banks basically, if they took their money and they just invested in, 10x Bitcoin, mining farms, and all these other things, they're not allowed to do that, right? They have to manage their assets and their liabilities. They have a banking commission that looks after them, and so on and so forth. So I'm not trying to defend banks here, but, there's a clear separation between people who are promising a return on somebody's investment, right? And, you have to use reasonable care as to, okay, I'm expected that I'm either lending this money out to somebody else, and there's a kind of mash of the investor who I'm lending it out and the return I'm getting, right? That's one thing. But to do these kind of crazy mismatched trades, this is unlike anything that you would normally see because it's just not allowed. You can't do that, right? Banks cannot operate like hedge funds.
Right.
But in crypto,
they did in 2008, right? Effectively, they basically took the money and gambled with it, right? Isn't that what happened? That's my understanding. What happened in 2008?
Well, yeah. They did a lot of crazy stuff. I mean, a lot of banks have systematically gotten in trouble over the years, and 2008 is not the only first time that happened. By taking crazy risks, right, and doing things. In the case of 2008, they bought these kind of crazy subprime collateralized bond obligations, and other things like that.
Credit default swaps.
Default swaps, things like that, right?
Yeah.
But in general, there's banks are regulated entities, so. Even in 2008, they weren't supposed to be doing that, but they did. They were able to. They were able to get around these so-called regulators.
I thought it was because they repealed Glass-Steagall. That is what sort of opened the door.
Well,
is that not true?
No, Glass-Steagall allows the banks to actually trade equities for people. So you can basically have banks are allowed to for their clients, sell you stocks. Before Glass-Steagall, you couldn't sell a stock. It was not possible. You had Merrill Lynch, you had Schwab, you had people who were securities brokers on one hand, you had Citicorp, Bank of America on the other hand. And after Glass-Steagall, there was no distinction.
Right.
Bank of America could sell you stocks. They could own, TD Ameritrade or something. So,
okay.
And they did. A lot of these banks, ended up. Bank of America bought Merrill Lynch, for example.
Right.
So, yeah.
Okay, let's move on to the future. So this happened. Bitcoin is now, roughly 20K per coin.
Yep.
Is the price of Bitcoin, in your view, kind of artificially low right now because of all these massive liquidations and cascading liquidations?
Not only because of that. I think that's part of it. I think there was. I think we have to look at where people were, before this all happened. And I think actually people were very bullish, right? So
yeah, I agree.
I think if you look back at the very beginning of the year, people started at the beginning of the year, and they were actually, okay, we're at this kind of very low point, say 40K, right?
Yep.
And 40K felt like the low, right? It felt like, okay, we're at the low, we're going to come, and we're going to go back, and we're going to make new highs, and we're going to go to 100K. So that was sort of the general feeling. And I think it was so prevalent that a lot of people were levered up that way, right? And 3 arrows, was massively levered up in that direction, right? So you had these hedge funds who were, had extremely long leveraged positions that they were betting that Bitcoin was going to go to the moon.
Yep.
And I think that you have sort of two independent things. One is the Federal Reserve sort of really moving to aggressively raise rates following kind of the inflation data that really came out in March, right?
Yep.
And so that was number one. And then, the May stuff on Do Kwon was really kind of unrelated, right?
Yeah.
But it's somewhat related because I think Do Kwon himself thought, hey, if I can buy Bitcoin down here, I'm going to make so much money on this Bitcoin because it's so cheap. So I think actually everybody was so bullish, and it's sort of like when everybody believes one thing, it's probably the absolute simple that it's going to go the other way.
That's the top. Yep.
Yeah. So I would say, realistically, I think if you asked most people 4 months ago, they would have all said that it's going to 100,000 completely. Now, where are we today? We're the exact opposite. I open my Twitter and it's like, could Bitcoin go to 5,000? Yes. 3 analysts tell you why.
Right.
So everybody's like, the market could go up 2% and then down 30%. Here's why our experts say that's the case, right? So, right now it's, the headline is sort of like new guy makes prediction that Bitcoin's going to go to zero. And so.
Well, it's done. It's actually, weirdly, despite all of this, I think Bitcoin is actually held up pretty well against the broader market. I ran some calculations the other day. If you had bought Uber at its IPO, you would have lost half your money by now.
Okay.
You'd have half left. If you'd bought Bitcoin on the same date, you would have double your money. So already doing better than one of the hottest stocks. Robinhood lost 80%. Like if you bought Robinhood on its IPO day.
Well, I think the two are related in the following sense. I think, in the short term, right now, I think there's this general feeling that macro is everything, right?
Yeah.
So people who aren't at all interested in the Federal Reserve or macroeconomics or any of this stuff are all of a sudden trying to go, what's the bond? What's the yield curve? What's 2s10s? And they're starting to read, they're starting to follow macroeconomists, like Lynn Alden and Luke Groman and, Raoul Paul. So everybody who's not interested in that all of a sudden is. So everybody's interested in macro. And they're interested in it by being terrified of it, right? So they're all terrified of the Fed's going to precipitate the, So I think right now, people are genuinely feeling that risk assets bad. Risk is bad. So there's a lot of feeling that I'm just going to get out, I'm going to sell, and I'll get back in when it's half the price, or a third of the price or something, right? So I think that's the mentality now. Now, I think what could happen, and I don't know, nobody knows the future, but I think what could very well happen is if we get more of this inflation, and if we sort of just give more time to this, people are going to start asking a different question, which is, wait a second, my money that I have sitting around is now losing 10% a year in value or more, right?
Yeah.
Like I definitely am maybe 20 to 30%, maybe 50% poorer than I was in dollar purchasing power than before the pandemic. My money, everything from food to restaurants, it's up 50% minimum since the beginning of the pandemic.
Yeah, agreed.
If I wanted to buy a new car, that's 50% more. Travel is more. So, if I wanted to buy a house, a second home or something, that's more, right? So people are realizing that their money is now, it is rapidly losing its value.
It's melting. It's shrinking.
It's melting. It's an ice cube, right? So, if you're going, oh my God, 10% inflation, that's bad. I got to get out of the market where I don't lose. Wait a second. Now I'm losing 10%.
Yeah, cash is not an escape. You're just invested in another asset that's losing.
Right. So I kind of feel, my gut feel is, that we're entering a decade that's going to be a lot like the 70s. And, if you look back at the 70s, what did well? Well, first of all, what happened in the 70s? We had high gas prices, OPEC, right?
Yep.
Very similar to now. Now it's not OPEC anymore; it's Russia, right? But we have, we have an external energy shock to the system. We had a sort of a labor shock, too, which is. In the 70s, it was unions. People were banding together and saying, "Look, you got to give us price, otherwise the union will not work." Now it's people working at home and saying, "I'm not going to come in. I'm going to sit at home. I might take 2 jobs at home."
What about real estate and property in the 70s?
It did really well.
Oh, it did.
Yeah, it did really well.
Surprising, isn't it? Yeah.
And
that's sort of
everybody would sort of say, "Okay, surely with 10% mortgages, 12% mortgages, it's not going to do well." No.
Right.
The average house tripled in price from 1970 to 1980. It tripled.
Wow.
Yeah.
That's insane. How did that happen? I don't know.
Well, the reason it happened is what do people want in times of inflation? They want hard assets.
Yep.
Right? So, you buy a house, you buy gold bars. And gold was like the best performing asset in the 70s.
Well, is that good for Bitcoin, do you think?
It's phenomenal for Bitcoin.
That's what I would think, too.
It is phenomenal. Just think about it. We went off the gold standard in 1971. Gold was $30 an ounce. It ended in 1980, it was like $300 an ounce.
Wow.
So it went up 10x, okay? Now, it's now at $1,700 an ounce. Okay, so it went up another 5x in the remaining 40 years, right? But not really done that well from 1980 to now. right? Because we've been in a disinflationary environment. Everything looked great. In a disinflationary environment, stocks are great, bonds are great, right? So if you look at what are the best assets from 1980 on, I would say bonds was the number one best asset. Because you could just buy a bond and get 10% interest for 10 years, for 20 years. You could buy a 30-year government bond and get 10% a year for 30 years in 1980, right?
Yeah.
So that was an amazing investment. No risk at all. Just collect a coupon and get it. And then, of course, you had equities that did phenomenally well because they were crushed during the 70s, right? Yeah. Nobody wanted equities. That was the worst. That was the worst investment in the 70s. So bonds
that suggests equities. Yeah, so that suggests equities now is a terrible thing to own. Like the stock market, you don't want to be in it.
You do not want to be in the stock market.
Yeah.
Right. So the stock market could go down it could go down by 3x. Okay.
Yep.
I mean, if we have the same playbook, right? And
right.
If we had the same playbook, stocks are going to go down. It'll just be the worst decade ever for stocks.
Yeah.
And it's hard to imagine this from an American standpoint because you're so used to stocks going up.
Never go up. Never go up.
But look, I mean, Japan, we saw this in Japan, which I was very involved in 1990, and the Nikkei was at 40,000 and went all the way down to 14,000, 20, 30 years later. So,
you're super loud.
Yeah. Yes.
Carry on.
So these long-term trends can be extremely painful, right?
Yeah.
And they can be long. And, I would say stocks are not cheap right now. They're not cheap and they could go down. Now, all of this now, it really depends on the Fed, right?
Yeah.
Because here's the thing. If the Fed continues to raise interest rates and that keeps on going on, and we have sort of a Fed policy that's like the 70s, I can tell you for a fact the stock market's just going to get decimated and the country's going to get decimated, right? It's just we're going to have a very high unemployment. You're going to have very high inflation. You're going to have very high interest rates. And nobody's going to want to buy U.S. government bonds. And the problem is right now we have, a debt to GDP of 130%. In the 70s, it was 30%.
Yeah.
But, so when you have
on a national level, we have a Terra LUNA thing going on almost.
Not almost.
We do have a Terra. So United States of America is the next Terra LUNA, maybe.
Well, no, the world.
The world.
Yeah.
So the everything bubble. Yeah.
It's the everything. So that's why it's very important to stress we're probably the best off of the major powers.
Yeah.
I would say we're the best. Europe's the second worst. And China's the absolute worst. Okay. And China and Japan is just hopeless. I mean, just hopeless.
Yeah, Japan looks like it's in a lot of trouble.
So,
all right, Fred. Well, we're getting pretty close to the 40-minute mark here, and your family's yelling at you. So
okay.
make sure we cut this off in a timely manner. This has been super fascinating. Thank you so much for coming on. And before you go, don't shut this window because I need the thing needs to upload your.
Okay, perfect.
It's basically it's got a local copy. It's uploading, so don't shut the window because I need the full thing.
Okay, perfect.
So just leave it open. Thank you once again, Fred.
Thanks, Mark.
And stay here.
See you. Okay. Yeah.
Bye.
Stay.
Okay.